You ever heard the term debt to income ratio and wonder what it is or how it's calculated? Learn why it's important in this episode. Sturgis Credit Repair is a 5-star rated online credit repair company. We help people just like you build or rebuild their credit scores. If you have no credit history, we offer products to help you build credit history so that you never have to depend on anyone co-signing for you. If you have bad credit, enroll into our service today and allow us to work on the negative items affecting your credit scores. We take no money up front, so start our service today for free. You'll get updated through your online account as well as receiving updates through your email. For those who are trying to buy a home, we're partnered with multiple real estate agents and loan officers who are ready to assist you with your goals. If you are a real estate agent, loan officer, or anyone dependent on customers with good credit, create a free partner account with us today. You can manually send or receive clients through your online account as well as track their progress before they go to someone else. Visit our website to learn more about our services. So many focus on their credit scores whenever they apply for something, but they never focus on their debt to income ratio. For example, you can have the highest credit score in the world, but if you cannot afford something, the bank will not approve you for it. Doesn't matter you have a 900 credit score, 800 credit score, 750, 10,000 credit score. If you simply cannot afford something, the bank will not approve you for that loan or for that funding. For example, if you make $30,000 a year and you're trying to finance a $500,000 Lamborghini or Ferrari or something like that, the bank is not going to approve you for that item because you cannot you can't just afford the item. You can't pay the bank the money back that they're loaning you. So I'm going to give you some examples here of how debt to income is calculated and why it's important whenever you go to apply for a mortgage loan or you're trying to finance a vehicle or anything like that. So let's see here. Let's first start off with a bank would not approve you for over 40% of your debt to income or 40% of your income. So debt to income is calculated from your debt being added or divided by your monthly gross income. So for example, if you make $3,000 a month and you have $300 a month worth of debt, then you divide 300 into this 3,000, and that's going to determine what your debt to income ratio is. So things that are included in your debt to income are things such as car loans, mortgage loans, the minimum payment on your credit card. So if you have a $1,000 balance on your credit card, that $1,000 isn't going to subtract your income. It's just the monthly, the minimum monthly payment, which is like $25 or $30 a month. That's going to be added to your monthly debt. So things such as your utility bills, you buying food every month, your fuel that you use to fill up your car, none of that stuff is calculated into your debt because it's not reported to your credit report. So again, the only thing that is included in your debt when you're calculating your debt to income ratio are things that are reported to your credit report. If it's not reported, the bank can't see it. They don't need to know. It's not included in your debt to income ratio. Now, there is a little twist to that when it comes to rent. So we all know that rent isn't reported to your credit report unless you use our rent reporting service with Sturgis Credit Repair and you build your credit history with our rent reporting product there. But most people who rent homes or rent apartments, those payments aren't reported to their credit report. So whenever you go to apply for a loan, there is going to be a section on the application that's going to ask if you own your home or if you rent. Most people just tell the truth and say their rent is $1,200, $1,500, $2,000 a month, whatever the case may be. Now, although they can't include that in your monthly debt, that is subtracted or deducted from your monthly income. So for example, if you make $5,000 a month and your rent is $1,000 a month, well, that $1,000 a month in rent is going to deduct from your $5,000 a month in monthly income. So now instead of making $5,000 a month, you make $4,000 a month, and then your debt to income is calculated based on a $4,000 a month income. So I'm going to break down a few examples here. So let's just say the first person makes $50,000 a year, which is usually equivalent to about $4,100 or $4,166 to be exactly. And let's just say this person have a $300 car note, okay? And this person has $0 in rent, or they have $0 in mortgage, and they just live with a family member. Or some people, when they go to apply for a car, they may rent their home and it's $1,500 a month, but since it's not reported to their credit report, a lot of people even go to the extra extent and lie on the credit report and just claim they live with a relative when they really don't, just so that rent payment isn't deducted from their income. Because when you're buying a car, they don't actually see any of your transactions from you living somewhere or getting proof that you're living with a relative. Now, when you're applying for a mortgage loan, there's no way to lie behind it. If you're paying $1,000 in rent and you lie on the credit app to get approved for more of a house, the mortgage lender is going to ask for 3 months or 6 months of bank statements. So they're going to question you, where's this $1,000 a month going every single month? They're going to see that you're paying somebody $1,000 a month. So you really can't lie about that on a mortgage loan, but usually some people get away with it when they're trying to finance a fancy car and they really need that extra money that they're paying in rent to make them afford more, which is a dumb thing to do, because if the bank say you can't afford it, you don't need to lie just to make yourself afford it. You want to only buy or finance something that you truly can afford under 40% of your monthly income. So moving back to this, so we got somebody that make $4,100 a month, $300 car note. They claim they have $0 in living. And let's just say they're trying to buy their first home, or they're trying to buy a home and have it reported on their credit report, and this is truly their first home. And let's just say they got pre-approved, or they looked at some homes, and based on the down payment that they have, the mortgage lender calculated that this home is going to cost this person $800 a month. So when you're going to apply for something, your current debt to income ratio has to be under 40%, including the new item that you're trying to get approved for. So this person currently have a $300 car note, makes $4,100 a month. Their debt to income ratio is about 7%, because if you take $300 divided into this 4,166, that's going to bring you down to 7%, meaning they have about 43% of their income, their monthly income left to just finance stuff that's available for them to finance. That's how much the bank will allow them to finance based on their monthly income. So they currently are at 7% debt to income ratio. And let's just say the home, we say it was $800 a month. So this $800 is added to the current $300 that they're paying every month in debt. Now they're going to have a $1,100 monthly debt. So now you take $1,100 divided into $4,166 a month. That's going to bring that person to usually probably around, let's see, I kind of did the math here. That's going to bring them around 26%. So they're well below the 40% debt to income requirement. So this person is going to have no issue being approved for this home as long as their credit score checks out great, of course. So that's example A. Let's move on to example B I've written down here. And this is just going to show you you can make all the money in the world. You can have the most perfect credit score. None of that stuff matters if you simply cannot afford it. So let's just say in example B here, some person makes $300,000 a year, which brings them around $25,000 a month. That's a lot of money per month that this person is bringing in. That person is almost bringing in half of the person in example A, half of their salary in 1 month. So they're bringing in $25,000 a month. And they're currently financing let's just say a fancy Lamborghini, and it costs them $7,000 a month for this Lamborghini. They also pay $2,500 a month in housing. Their home costs $2,500 a month for their mortgage. This totals out to be about $9,500 a month, which is more than what some people make in a month. So this person has $9,500 in debt. They make $25,000 a month. This is gonna bring this person debt to income ratio about 38%. Now, this person is trying to finance a second Lamborghini, which is going to cost them an extra $7,000 a month. And if this person were to go out and try to apply for this Lamborghini, well, that $7,000 would put them at 66% debt to income, because they currently have $9,500 in debt, and they're trying to add on an extra $7,000. That's insane. So that's going to be about a 66% debt to income ratio. They're going to have to put down about probably 95% of the Lamborghini's price just to be able to finance it, because the bank is not going to approve them for the whole entire loan amount or the vehicle amount. So before you finance something, just make sure your debt to income checks out right. You're going to be well under 40%, including the new item that you're trying to apply for. This is going to save you so much time running your credit for no reason. You're putting hard inquiries on your credit report for no reason. And again, like always, if you have something that is affecting your credit scores, definitely reach out to us here at Sturgis Credit Repair, and we can work on getting those items removed off your credit report so you can go on and start financing things in the future, or getting homes or getting vehicles that you want to use for work or personal purposes. So I hope you guys learned something new from this episode. And as always, if you have any questions, definitely reach out to us. Thank you. If this video helped you, be sure to like it, comment, share it, and subscribe to this channel for more helpful videos like this one. Thanks for watching.